The Rebel Capitalist Show.
As people can see, inflation continues through the years. The official rate on average is only 5.1%. Okay. The real rate, as we all know and your listeners know, is much higher. But at the end of this 30-year mortgage, the dollar is now worth only 24 cents versus what it was worth 3 decades earlier. And so we've got a dollar that's only worth 24 cents. The last payment on that mortgage is the same amount the first payment was in nominal dollars. You're still writing the check for $101 per month.
Right.
But the feel of that check, the real value of that check after inflation-induced debt destruction, is only $24.
Right.
This is beautiful. Okay, only $24, and so that's incredible. Now, if we total this up in sum, let's look at how this all worked out. Let's go back to the beginning, and remember that we borrowed just a little over $14,000, and with the interest in nominal dollars, we repaid over $36,000.
At 7.3%, by the way.
Yeah, much higher rates than today. And this is why a lot of people get this faulty idea, this very wrong, bad idea, okay, that you want to pay off your mortgage early. Right? Why would you ever pay off your mortgage early? Well, they look at the interest amount and they think, they sit there when they're signing the loan docs and one spouse says to the other, honey, we're going to repay $36,000 because it's on the disclosure, right? They see that in advance. The lender has to show it to you. And they think, if we can just make one extra payment every year or pay a little extra every month, we'll pay this off in half the time. No, don't do that. It's a terrible idea.
So they're just thinking about it in today's dollars, assuming they're extrapolating that forward into the indefinite future.
Yeah. They don't understand the idea of inflation-induced debt destruction. And fortunately, everybody listening does understand that, and they will not do that. So in real dollars, after inflation took a bite out of the debt, okay, these millions of people, okay, only repaid $16,393 when they thought they repaid over $36,000, and they borrowed over $14,000. Okay, so in real dollars, they repaid just over $16,000, meaning their 7.37% mortgage, really the effective rate was only 1.06%. That's wonderful. But after tax benefits, because that mortgage interest is tax deductible, okay, now this could vary based on someone's tax bracket, obviously. So this is just an illustration. Understand that, talk to your CPA for, your personal situation. Okay. But they only repaid after inflation and tax benefits $12,655. Okay. Which means they got paid to borrow the money. They got a truly negative interest rate of 1.16%. They got paid to borrow the money. And that's only based on the official inflation numbers. And they lived in the house for free. They got a place to live. They didn't have to pay rent somewhere. Okay. Now, if this were a rental property and you had the real inflation numbers in here, this example would be dramatically better. Not that it needs to be, because it's a darn incredible scenario already. But it would be much better if you weren't making your own mortgage payments.
I see prices right now coming down to the levels they were in 2012.
I watched your great video on that, by the way.
Yeah, and so the question is, are they going to come down in nominal terms or in real terms?
George, I do have one more thing, though, I want to share.
Yeah.
So, there is a lot of talk, as there always is, of, will prices continue to go up, housing prices? Are we in a bubble? the prices are high, blah, blah, blah. We talked on a prior episode about the mortgage payment versus the house price, and me saying the mortgage payment is more important. But I want to make this prediction, memorialize it. If I'm wrong in 5 years, tell me I was an idiot, but I think I'm going to be right, and I want to get credit, okay?
All right.
Because I think I'm going to be right about this,
Cool.
okay? And here's the prediction, okay? And yeah, I saw your video that you did, an excellent video about how, what if mortgage payments go up to 8%, like a more realistic mortgage rate, that would make housing cost a lot more every month, and you're definitely all right about that. But here's the thing that really nobody's talking about except me. It's the supply side of the equation. And I think the millions of people that have refinanced their homes or purchased new homes with these artificially cheap mortgages are going to hold them like it's a life raft. They're not going to let them go because the mortgage can't be transferred to a new property. And so that is going to constrain supply dramatically. If rates go up, these mortgages that are out there at 2.75% or whatever this insanely low rate is, are going to become so valuable that nobody's going to want to let them go. So maybe there's a stock tip in here. So Home Depot stock and Lowe's stock and contractors that do additions onto homes and landscaping companies, they're all going to be booming business because people are going to stay in place. Okay, they're going to be incentivized to stay in place and improve their house, or they're not going to let their house go and they're going to turn it into a rental property. Okay, so supply, there is already a structural, I'll use it like everybody talks about systemic racism, right? I'm going to call it systemic shortage in housing. Okay, we have a systemic housing shortage, and this housing shortage will be exacerbated by all of these owners that have these artificially cheap mortgages that are not going to sell their properties. And that's going to make the shortage even worse because they're not going to relinquish the properties. Even as people are aging in place, technology is allowing people to age in place. They don't have to go into a nursing home and sell their house. Okay, if they have an Apple Watch, they can be monitored by their relatives, their healthcare providers. All this kind of technology that just keeps getting better and better. So there's going to be a lot of people that just don't put their houses on the market. That's my prediction. And I think that's going to cause upward pressure on prices and upward pressure on rents in the future.
Yeah. My only prediction is that housing prices will come down to their historic trend line, but I don't know if they'll come down just in nominal terms or in real terms. I don't know. So what we're saying there, guys, is if you're thinking that through, we could both be right. Jason could be right in the sense that housing prices go up, and I could be right in the sense that housing prices come back down to their historic trend line adjusted for inflation.